Welcome to This Explainer. Today, we're not just going to passively look at a stock. We are going to completely tear it apart and rebuild it using the rigorous frameworks of history's absolute greatest investors. Think of this as an elite financial masterclass. We're putting Nasdaq, ticker symbol NDAQ, under the microscope. By blending the core philosophies of Warren Buffett, Peter Lynch, and Benjamin Graham with some modern discounted cash flow modeling, we're going to figure out exactly what this market giant is truly worth.
Okay, let's dive into this. Here's our roadmap for the analysis. We'll start with a quick snapshot and apply the Buffett lens. Then we'll move right into Peter Lynch's framework, run the strict Benjamin Graham defensive checklist, build out a DCF valuation, look at a couple of alternative models, and finally bring it all together for our synthesis and recommendation.
Section 1. Snapshot and the Buffett lens, seeking the moat.
Let's establish our baseline facts here. Nasdaq is currently trading at roughly $93 a share, which gives it a massive $51.4 billion market cap. Now keep in mind, you aren't just looking at a place where stocks are traded. You're looking at a $51 billion central nervous system for global finance, one that's been steadily compounding revenue at nearly 8% a year for the last 5 years.
And this right here perfectly illustrates Warren Buffett's ideal economic moat. Nasdaq basically has a monopoly-like infrastructure. They boast a staggering 74% IPO win rate. They even landed the massive SpaceX IPO. But here's what Buffett really loves: predictability. A full 38% of their recurring revenue is now software as a service. When you add in a very healthy 16.9% return on equity and a highly manageable debt leverage of 2.6x, you're looking at some tremendous consistent earnings power.
Now, to truly apply the Buffett lens, we've got to calculate his famous owner earnings. Basically, this is the actual cash you'd put in your pocket as an owner. We start with their $507 million in Q2 net income, add back depreciation, since those are just non-cash paper expenses, and then we're using their reported free cash flow of $477 million as our proxy to bridge the capital expenditures data gap. The main takeaway: their cash engine is just incredibly healthy.
So they have a strong moat? Absolutely. But remember, a true value investor like Buffett demands a margin of safety. If we take those cash flows and apply a conservative safety net, our hypothetical buy price triggers closer to $75. It is a wonderful business, no doubt. But for Buffett, the current $93 price tag just doesn't quite offer that deep, comfortable discount.
Section 2. The Peter Lynch lens. Growth at a reasonable price.
Over in Peter Lynch's universe, you always categorize the company first, and Nasdaq is very firmly categorized as a stalwart. Basically, that's a massive established company that still manages to offer reliable long-term growth. And the data perfectly backs this up. With its $51 billion size, Nasdaq has delivered a very robust 5-year earnings per share growth rate of 10.65%. So it's not some hypergrowth tech startup, but it is a remarkably steady wealth compounder.
So the crucial point for Lynch is the PEG ratio. To find that, we take Nasdaq's current PE of roughly 21.7 and divide it by that historical 10.65% growth rate. That gives us a PEG ratio of 2.04. Lynch ideally wants to see a PEG of 1.0 or lower. So at over 2, it tells us the market is currently pricing in a pretty massive premium for Nasdaq's growth.
Just to round out Lynch's checklist, we're looking at a stable balance sheet with a 1.0 current ratio. Total debt to equity is elevated but stable, institutional ownership is standard, and the insider buying vibe is pretty much neutral. So combining that solid financial footing with a PEG ratio sitting over 2, the final Lynch verdict is a solid hold. It's a great stalwart for sure, but right now you're paying full price without any obvious hidden asset plays to capitalize on.
Section 3. The Benjamin Graham lens, the defensive investor.
All right, get ready, because we are about to run Nasdaq through Benjamin Graham's notoriously cold, hard quantitative checklist. Step 1, adequate size, pass, easily, at over $50 billion. Strong financial condition, it's borderline. Graham really liked a current ratio of 2, and Nasdaq is sitting right at exactly 1.00. Earning stability, pass, it's highly consistent. Dividend record, pass. But step 5 is where the wheels completely fall off. Moderate PE and price-to-book multiples, massive fail. With a PE around 21 and a price-to-book ratio of roughly 4.39, Nasdaq spectacularly fails Graham's incredibly strict valuation limits.
Let's actually do the exact math on Graham's famous intrinsic value formula. We're assuming an annualized EPS of $4.28 based on their strong Q2 numbers. And we pull a book value per share of $21.20 straight from the balance sheet equity. When you run that through Graham's rigid multiplier, the square root of 22.5 times those inputs, the calculated intrinsic value comes out to a shockingly low $45.18.
And there it is, the brutal Graham conclusion. At $93.16, Nasdaq is trading at a massive 106% premium to Graham's intrinsic value. With absolutely zero margin of safety and a huge premium over book value, the father of value investing wouldn't touch this stock with a 10-foot pole at this price. Honestly, for his purely historical metrics, it's a definitive sell or avoid.
Section 4. Discounted Cash Flow Valuation, Projecting the Future.
Now, let's pivot away from historical multiples and project Nasdaq's actual future cash generation using a modern DCF model. Here are our explicit base case assumptions. We start with $1.90 billion in annualized free cash flow. We project that out at our historical 10.65% growth rate for 5 years, followed by a 2.5% terminal growth rate. For our discount rate, building off the source-provided 3.7% cost of debt, we assume a very favorable weighted average cost of capital of 7.0%.
Now, what's really interesting about this result is how the narrative totally flips here. When you project those cash flows forward and discount them back to today, the fair value per share comes out to $98.50. So unlike the strict historical multiples we just looked at, a purely quantitative DCF model completely justifies the current $93 price tag.
But valuation is an art just as much as it's a science. That's why we always run a sensitivity table. Look at how slight shifts alter the value. If interest rates spike and push our required WAC to 8%, fair value drops down to $80. But if they can sustain a higher 3% terminal growth, value jumps all the way to nearly $108. So our $98.50 base case sits right in a highly plausible, very realistic middle ground.
Section 5. Alternative Valuation Models, DDM, and Comparables.
We want to leave no stone unturned, so let's look at the dividend discount model first. We take their $1.24 annual dividend and project a conservative 8% growth rate against an assumed 10% cost of equity. Now, despite them having a fantastic historical dividend growth rate of 10.8%, because Nasdaq reinvests so much of its cash back into growth and acquisitions rather than just paying it all directly to you, this strictly dividend-focused model yields a highly conservative fair value of just $66.96.
Next up, comparable company analysis. If we apply a pretty standard 20x PE multiple for the financial sector to our estimated EPS of $4.28, it brings us to an implied fair value of $85.60. So looking at our alternative models, they create a value range roughly between $67 and $85, which is sitting slightly below current trading levels.
Section 6. Synthesis and Final Recommendation.
This master summary table perfectly illustrates the real tension in modern market valuations. The forward-looking quantitative DCF model is basically screaming buy or hold at $98.50, but that heavily clashes with Graham's old-school conservatism down at $45, while it sits just above Buffett's required margin of safety trigger around $75. It's quite the tug of war.
So what is our final impartial takeaway? Well, the strengths are completely undeniable. An unshakable moat, explosive index AUM, and rapidly expanding SaaS revenues. The key risks, that 2.6x leverage ratio and a hefty premium to its book value. Blending all of this data together, our final synthesis opinion is a hold. You're looking at a magnificent business, but it's at a fully realized price, which leaves us with a really provocative question to think about. Does a modern, tech-driven monopoly like Nasdaq justify abandoning traditional Benjamin Graham value metrics forever? Think about that as you review your own portfolio. Thanks so much for joining me on this explainer, and keep learning.